Welcome to the Participant Education Program, learning about target date funds. Today we're going to learn about an important option available to all participants in your company's 401k program, the target date fund. Over the next few slides, we will cover target date funds, what they are, how they work, and why they can be a good default investment option in your 401k. We will also go over some risks target date funds are subject to, and the most important piece of all, your 401k savings rate. Before we jump into the target date fund specifics, let's touch on where it falls within your retirement landscape. You may recall how your financial health in retirement is made up of a number of factors. Some factors are out of your control, and others you can directly influence. Ultimately, you only have total control over 3 areas that affect your retirement: how much you save, how much you spend, and how you choose to invest those savings. Selecting your asset allocation, as seen at the top, is an area you have complete control over and directly impacts your 401k's performance. The investments you choose make up your asset allocation. Today we are taking a look at target date funds, which is one way of investing your money for retirement. Target date funds are available through your company's 401k plan and may be a good investment option for you to consider. So let's find out more about target date funds. A target date fund is a single fund designed with the goal of carrying you through both your career and your retirement. It is typically constructed as one fund made up of several underlying funds. These various underlying funds are typically focused on broadly diversified investment strategies. The specific mix of investments in the target date fund itself is based on an expected retirement year, the year you turn 65. As you get closer to retirement age, the investments within the fund become more conservative to reduce risk. Target date funds can simplify your investment decision and provide a diversified investment portfolio in a single fund that is specific to your planned retirement year. The target date referenced in the title is the approximate year when you turn 65. You may have seen target date fund options available through your company's 401k plan, such as a Vanguard Target Retirement 2045 fund. In this example, I am turning 65 in 2045, so I would select Target Date Fund 2045 as my 401k choice. As the fund nears its target date, the investments within the fund gradually become more conservative to reduce risk. The pace at which this occurs is called the glide path. Each target date fund option is invested in numerous low-cost mutual funds to create a broad mix of stock and bond holdings. The further out someone is from retirement, the higher the amount of stocks versus bonds that will be in the fund. For example, someone expecting to retire in 30 years will have more stocks than bonds when compared to someone 10 years away from retirement age. In general, stocks have more risk, but can offer a higher potential for growth. As you can see on the graph to the right, over time, as an investor nears retirement, the investments within the fund will gradually shift to become more conservative and lower risk. The amount of stocks held within the fund will decrease, and the amount of bonds carried will increase. The glide paths of target date funds track the shift in the investments held over time. If you look at the image here, you may see that initially, the funds may hold significantly more U.S. stocks, as seen in pink, and as the target date of the fund is reached, the glide path then shifts to include cash and more Treasury inflation-protected investments. Across the majority of target date funds available, portfolio managers typically apply a similar long-term strategy. Start with higher allocations to riskier investments, such as equities or stocks, when the fund is, say, 50 years away from its target date, then rotate into more conservative fixed income investments, such as bonds, as the fund approaches its target date. Conceptually, this means the portfolio manager is trying to grow the investor's capital, or total investment, in the earlier years of the fund, and then he or she shifts toward protecting the investor's savings as the fund approaches and goes beyond the target date. Each target date fund offered will have a slightly different glide path and allocation mix. It is important to note that target date funds do not allow for individual investor customization and may not take into account an investor's specific risk tolerances. To retirement versus through retirement. Historically, the glide paths of target date funds have been designed in one of two broad ways. The first is to retirement, which uses the estimated retirement year of the investor as the time horizon for the glide path, as seen in blue below. When the target date is reached, the asset allocation of this type of fund becomes fixed. This does not mean that a target date 2020 fund is going to liquidate itself or end in 2020. This type of target date fund typically results in an investment mix that is much more focused on generating annual income once the target date has been reached. The second way target date funds can be oriented is through retirement, as seen by the red line on the graph below, which uses the estimated retirement year plus a number of years, typically anywhere from 10 to 30, as the time horizon for the investment portfolio. Broadly speaking, this approach is intended to reflect the reality that people are living longer, and as a result, their retirement savings need to last longer. This approach typically results in an investment mix that retains more of a growth orientation for longer, including after the target date has been reached, than funds that manage to retirement. Why target date funds can be a good default option. They are designed to take the time and often the guesswork out of selecting an appropriate 401k option. There's only one choice to make when choosing between target date funds. Select the fund with the year in the title closest to when you plan on retiring. They are generally low in cost. Your company has selected Vanguard target date funds as of the time of this module, which have some of the lowest expense ratios or costs available today. Target date funds can also leverage the experience and academic research of industry professionals in selecting the direct investments. As previously mentioned, the fund will gradually shift over time based on the fund's glide path. They are structured to maximize your investments while minimizing your risks. Many target date funds, like the ones offered through your company's plan, have glide paths that do not end on your retirement target date. You will not have to transfer your money to another investment. Some of these funds are designed to carry on another 10 to 30 years past the year you retire. While talking about the benefits of target date funds, I'd also like to highlight some of the primary risks involved. The three main risks you may encounter with target date funds are longevity risk, or the risk that you outlive your retirement savings, market risk, the risk that an investment will decline in value due to overall market performance, and inflation risk, or the risk that a dollar in the future is worth less than today and will not buy as much. For an example of inflation risk, the price of a loaf of bread was 5 cents 100 years ago. Today, a loaf of bread costs on average $1.40. So bread today costs 28 times more than it did 100 years ago. That's an example of inflation risk. Portfolio managers of target date funds focus on the balance between these three key risks. At the end of the day, it's all about savings. As you can see from the image below, the single biggest factor in whether or not you have enough money to last you through retirement is your savings rate, or the percentage of your paycheck that you put towards your retirement. How old you are when you retire, how much of your current income you will need each year, and the cost of your investments, or that expense ratio previously mentioned, all play a part in the long-term impact on your retirement. But as you can see, none of them matter nearly as much as the percentage of your paycheck that you are regularly contributing to your savings. Start as early as you can, contribute regularly, and consider increasing your savings contribution rate each year for the best chance at success. Thank you for watching our education program video for 401k participants. Our goal is to provide you with information to help you make better choices in your 401k plan given your personal situation and goals. Ultimately, the choice is yours to make. We are here to answer questions you may have along the way. Please feel welcome to contact us at 818-340-0157, email us at info@crugg.com, or visit our website at charlesworthrug.com. Thank you.